21 miles. That is all. In the context of global geography, it is a trivial distance, shorter than a typical morning commute in New York, Chicago, or Los Angeles. Yet history teaches us something uncomfortable. World wars do not always begin with grand declarations. They begin with choke points. They begin where trade routes tighten, where energy flows constrict, where miscalculation meets leverage. The Strait of Hormuz, just 21 miles wide at its narrowest navigable corridor, carries nearly 20% of the world's petroleum and liquefied natural gas. If a systemic global conflict were ever to emerge in the modern era, it would not begin with armies crossing continents. It would begin here. When tensions escalate between Israel and Iran, this narrow waterway ceases to be a geographic coordinate. It becomes a global economic trigger. For the sophisticated investor, missile exchanges and naval deployments are surface-level events. Beneath them lies a far more consequential mechanism, one that connects a regional security confrontation to Federal Reserve policy, sovereign bond yields, equity valuations, and the purchasing power of households across continents. This is not simply a territorial dispute. It is a stress test of the modern financial architecture. The friction between Israel and Iran represents the evolution of a decades-long shadow conflict into direct conventional signaling. For Israel, the security calculus is existential. Strategic threats are assessed not in quarterly earnings cycles, but in generational risk. For Iran, geography is leverage. The ability, or even the credible threat, to disrupt the Strait of Hormuz functions as asymmetric deterrence. And for the United States, the strategic involvement is layered and delicate. Washington maintains an ironclad security commitment to Israel. Simultaneously, it must preserve global energy stability to prevent renewed domestic inflationary pressure. The stakes extend far beyond the Levant. A miscalculation in the Persian Gulf does not remain regional. It challenges the foundational assumptions of globalization: reliable shipping lanes, predictable commodity pricing, and low-cost cross-border trade. The primary economic transmission mechanism is energy. Approximately 20 million barrels of crude oil pass through the Strait of Hormuz every 24 hours. Global markets operate on the assumption of uninterrupted flow. When that flow is threatened, futures markets respond instantly. Brent crude benchmarks can spike 8 to 12% on probability alone. The pricing logic is forward-looking. It is not based on present scarcity. It is based on anticipated disruption. That risk premium becomes an invisible tax embedded into every supply chain on Earth. The shock spreads through shipping and insurance markets before a single tanker is delayed. War risk premiums for vessels transiting the Gulf can jump from near zero to over 1% of hull value overnight. On a $200 million supertanker, that equates to a $2 million increase in cost for a single voyage. These costs cascade downward. Diesel powers roughly 90% of global freight ton miles. Higher fuel costs elevate shipping expenses. Shipping expenses feed into producer prices. Producer prices flow into consumer inflation. This is how a confrontation in the Persian Gulf reaches supermarket shelves in the United States, factory floors in China, and fuel pumps in India. Global power alignments are simultaneously being stress tested. The United States retains dominant naval capacity in the region, but escalation management grows more complex with each exchange. Iran recognizes that it cannot outmatch Western conventional power directly. Its leverage is disruption. Israel calculates risk differently, prioritizing strategic degradation of threats regardless of immediate market volatility. China faces a distinct vulnerability. Asia imports more than 70% of its crude oil through the Strait of Hormuz. China remains the world's largest crude crude importer and manufacturing engine. Sustained oil prices approaching $100 per barrel materially compress Chinese industrial margins and complicate domestic growth targets. Beijing has expanded its strategic petroleum reserves, estimated to cover several months of imports, but reserves are temporary buffers. They are not permanent solutions. At the same time, China has accelerated energy trade settlement in yuan with certain partners. While the dollar-based system retains unmatched liquidity depth, incremental diversification signals a gradual shift toward multipolar settlement mechanisms. India's strategy is equally nuanced, though driven by economic arithmetic rather than ideology. India imports approximately 85% of its crude demand. Energy volatility translates directly into inflation risk and fiscal strain. Since 2022, India has pivoted significantly toward discounted Russian crude. Purchased below global benchmarks, this supply mix stabilizes domestic pricing while enabling refined product exports into global markets. This dynamic illustrates a critical reality of modern trade. Sanctions reroute flows. They rarely eliminate them. Russia, meanwhile, occupies a paradoxical position. Higher global oil prices bolster Russian fiscal revenues, even when crude is sold at discounted rates. Simultaneously, Moscow and Tehran have expanded alternative financial settlement channels outside the traditional SWIFT system. These mechanisms remain limited compared to dollar liquidity, but they represent incremental fragmentation of the global financial order. When geopolitical shocks strike, financial markets react with familiar patterns, though outcomes are increasingly complex. Traditionally, crisis triggers a flight to quality. Capital flows into the US dollar. This phenomenon reflects structural dominance. Energy contracts, sovereign debt, and trade settlements are largely denominated in dollars. When oil prices rise, importing nations require additional dollar liquidity. The dollar strengthens. Emerging market currencies weaken. However, the U.S. Treasury market reveals a subtle paradox. In standard risk-off environments, investors purchase treasuries, driving yields lower. But when geopolitical tension drives sustained energy inflation, investors begin to fear structural price instability. If 10-year yields rise during crisis, it signals inflation concern outweighing safety demand. This places the Federal Reserve in a constrained position. Interest rates cannot produce oil. They cannot reopen shipping lanes. They can only suppress demand. The risk of stagflation, stagnant growth combined with persistent inflation, becomes more than theoretical. Equity markets respond with sector rotation. Growth equities, sensitive to discount rates, face pressure. Energy producers, defense contractors, and firms tied to sovereign expenditure outperform. National security budgets expand irrespective of the economic cycle. We are entering what many analysts describe as a defense supercycle, a period in which geopolitical instability embeds permanently elevated government spending. Looking forward, these shocks are accelerating structural transformation. The just-in-time model of hyper-efficient globalization is giving way to just-in-case resilience. Supply chains are being regionalized. Manufacturing redundancy is increasing. Friend-shoring is replacing pure cost optimization. Resilience improves security. It also raises structural costs. Inflationary pressure becomes embedded rather than episodic. The US dollar remains dominant, supported by capital market depth and institutional trust. Yet, repeated sanction deployment has accelerated experimentation with alternatives. The architecture for a multipolar currency environment is gradually forming, not through dramatic collapse, through incremental adaptation. Geopolitical tensions between Israel and Iran are not isolated flashpoints. They are interconnected nodes in a system defined by energy flows, capital allocation, and currency dominance. 20th century world wars were fought over land and ideology. If systemic conflict defines the 21st century, it will center on infrastructure and liquidity, shipping lanes, commodity corridors, bond markets, currency systems. The world economy was
optimized for a prolonged peace. That peace is now more fragile than markets once assumed. Investors who navigate the coming decades successfully will not fixate on daily headlines. They will monitor structural realignments in energy security, monetary policy, sovereign debt, and trade architecture. Because modern conflict is not measured solely in territorial gains. It is measured in the integrity of trade routes and the credibility of money itself. If you value rigorous, data-driven macroeconomic analysis that looks beyond surface narratives and into the architecture of global finance, subscribe and join our community. The next decade will not be defined by growth alone. It will be defined by resilience, and resilience carries a cost.
You must consider the long-term impact of these shifts on global wealth. The transition toward localized production requires significant capital investment and new logistical frameworks for international trade. Each nation must now balance its economic interests against rising geopolitical threats. History suggests that those who adapt to new realities quickest will maintain their competitive advantage. The margin for error in fiscal policy has narrowed significantly for major central banks. We are witnessing the birth of a new era in global economic management. Stability is no longer a given. It is a resource that must be actively protected. The tools of the past may not suffice for the challenges of tomorrow. Understanding these dynamics is essential for any participant in the modern global financial system. Patience and strategic foresight will be the hallmarks of successful capital preservation and growth. Join us as we continue to track these evolving trends across the global landscape. This is the new reality of finance. Stay informed, stay resilient, and stay prepared.